July was an interesting month, which is always a euphemism for we lost money, as markets were very volatile with a sharp sell-off in originally AI-related equities, which broadened out into more tech and then equities more broadly. Thankfully, there was a rally on the last day of July, which brought some stocks back up for the month, but the sell-off has continued into this month. And I think it's worth stepping back and thinking about what has provoked this. So in mid-July, there were earnings by some of the big tech firms in the US released that suggested their spending on building out artificial intelligence infrastructure and capability was growing leaps and bounds. There were questions being raised about, well, is all this spend going to turn into earnings that are positive, and are we going to see some benefits? And that's where none of the big tech firms had a clear answer about the obvious near-term gains. So the market got nervous and began selling those stocks.
In the equity content, the previous winners of the last month, the high-tech names, the Microsofts, the Qualcomms of this world, did fantastic well for us. But this month, obviously with the sell-off in the technology sector we've seen, those assets didn't help us this month. They detracted from performance. What did help us was the dull, boring stocks that people ask, why do you own these companies? Coca-Cola, which we put into the portfolio, has actually had a positive return for us. Thermo Fisher, United Health, these types of companies are not exciting, they're not super high tech, but they are consistent companies with consistent earnings that roll through any type of economic environment.
And then you had some data, particularly in the US, that was weaker than expected as far as the state of US growth, in particular the labor market data that came out at the beginning of August. And that showed much slower job growth than was anticipated. The market got itself thinking that, oh my gosh, a US recession is imminent. The Fed has waited too long to lower rates. Armageddon. And so equity markets sold off broadly. In fact, the Nikkei 225 index lost over 20% in 3 trading sessions, which is really staggering. There can be an awkward combination in markets when valuations are really rich, and then you lose some of the underlying economic themes that are supporting those valuations, and you get something that points in the other direction, the market can tumble very quickly. In moments like this, the best course of action is really to do nothing. It's because it's not clear if this sell-off is finished. It's not fully clear what all the motivations are behind it, but I think this is a time to be grateful that you've got fixed income in your portfolio. For example, the Solutions Fund did much better in the month than Dynamic because it holds about 40% in fixed income, where fixed income prices rose and yields fell in response to equity markets selling off and concerns about recession, and that's what fixed income is supposed to do in your portfolio.
With interest rates now higher, fixed interest markets provide that buffer and protection they should traditionally provide in periods of market volatility. Whilst we remain concerned about the longer end of the market, we're focused at the shorter end of the market, and this is where we see less volatility, but we actually saw positive returns from this as interest rates started to reduce. This has helped the portfolio, and particularly in solutions. And this is really why, for those people owning solutions, that blend of assets is there to provide that downside protection in kind of periods of equity market stress.
We don't think the US is going into a recession. Yes, the economy is slowing, but the Fed has pretty much assured us that they're going to cut rates next month. The Bank of England just cut rates. The ECB cut rates in June. So I think the central banks are being proactive and already lowering rates. So any downturn in activity will probably be shallow and not last very long. So we think the backdrop for economic growth remains healthy. It wouldn't surprise us if this kind of volatility continues over the next few months, but we still have an optimistic outlook about growth and then what that will mean for corporate earnings and the securities that we hold in the portfolio. We at Oak Glen are here to help you, and for more insights, please look at our website.